Markets are crashing. Inflation is at the highest rate it's been in years, and we're on the verge of what seems to be an inevitable recession. And I'm about to buy Bitcoin. And what I want to do in this video is explain the reasons why and teach you a little bit about swing trading in the cryptocurrency market. I'm not long-term investing, expecting this to be the bottom of Bitcoin, but rather trying to catch a bounce. So I'm going to explain to you why I feel like Bitcoin has the possibility of bouncing and the entire strategy to you throughout this video, but also I want to make sure I put my money where my mouth is. As you can see, we are on my real Coinbase account. I have more than this portfolio. I have roughly 121,000 in this portfolio, but right here I'm about to buy $10,000 worth of Bitcoin. There we go, success. I have now bought $10,000 worth of Bitcoin, which cost me $60. These fees are outrageous. But if you want to learn all about the swing trading strategy I like to use in the crypto market, go ahead and click that like button. Go ahead and subscribe if you are new, and I'll be right back to share the entire strategy with you. Welcome back, and let's go ahead and get right into it. Today I'm going to be teaching you an entire rules-based strategy around trying to find pullbacks in the crypto market. Now, let me explain first what I mean by pullbacks. When there is a trend in any direction, we're going to use a downtrend for an example because that's what everything's doing right now. So when price is in a downtrend, what happens? We have a big move down, then we always see a little bit of relief, a retracement, a pullback. Then we'll see another move down, a pullback, another move down, a pullback, and another move down. If we can catch the bottoms of these pullbacks and this pullback up, we can find really good trading opportunities to capture some money. And also, sometimes we can get lucky and see a complete reversal. So that's essentially what we're looking at with this strategy. And let me show you what I mean. In an uptrend, as you can see, price pushes up, we get a pullback, pushes up, we get a pullback. Every now and then we push up, we get lucky by capturing this big move down. The same goes for a downtrend. We push down, pull back, push down, pull back, push down. Every now and then we get lucky and get a big move. The problem is most traders are just guessing at when this big move might occur, or even at when this pullback may occur. So what I want to do is give you some really set in stone rules for a strategy where you can point out these levels in an objective way so you're no longer confused, and it's a way that has worked for me in the past in terms of making money from catching these pullbacks using it for a swing trading strategy. So with that said, before we get into the technicals of this strategy, let me explain the reason I like trading this strategy directly after big news events. Whenever you were young, I don't know if you were ever like scared of shots or scared of needles. I know I was. I used to hate getting shots as a kid. So when I was young, I would always fear going to the doctor. It would like freak me out going to the doctor when I knew I had to get a shot. And what would normally happen is after getting the shot, I realized all that fear, all that anxiety was for nothing. Yeah, the shot hurt, but it wasn't as bad as I thought it was going to be. Now, with big news events like inflation, yeah, inflation came in at like 9.1%, but after the news came out, it's kind of like being the kid that's scared to go to the doctor. After the news comes out, you realize, oh shit, I was scared, I was afraid, but the world's not over just because inflation's that high. It doesn't mean everything's ending. So there's a bit of relief. And I'm not saying that it means there's a bottom to the market. There's definitely not a bottom whenever you see inflation that high, because the suits are going to eventually speculate on what the next inflation and interest rate is going to be, and that's going to bring all the fear back into the market. But immediately after the release of news, most of the time, there is some relief in financial markets. What's another word for relief? When a market's pushing down, relief is a pullback. So right after a news event like that, whenever we actually get the news and there's no longer a big unknown in place of what that news was going to be, a lot of times we'll see pullbacks before the continuation of the direction the trend was in beforehand. So that's kind of what we're trying to capture from a fundamental analysis standpoint. It's not necessarily a rule, but I do love trading this strategy directly after major news. And when I say directly after, I mean like a day after, not literally the day of. So let's go ahead and take a look at the actual technicals. So from a technical perspective, this strategy is pretty damn simple. All we're looking for, as you know, if you've watched the channel for a while, I'm pretty big on previous levels of structure. So all we're looking for is previous levels of structure, and in this specific situation, an ascending wedge. In case you don't know what an ascending wedge or an ascending triangle, I don't care what you call it, is, it would be price pushing down, then pushing up to a resistance level, then having a higher low, same resistance level, higher low, same resistance level. A lot of times this can signal a breakout to the upside. Not every time, and trading ascending wedges anywhere is not profitable. Trading ascending wedges on their own with a 1-to-1 reward to risk ratio probably wouldn't be profitable. So it's a lot about the way you trade these patterns, which is what I want to dive into now. So ascending wedges are super simple. I don't feel like I need to go into more detail on what those are. So that's an ascending wedge. The next step, or the first step actually, is looking for a level of structure that is prominent and relevant to this market. If we look left on Bitcoin, you can see that we had some major resistance from the exact area we are in right now in the past on this market. So that means we are at a major level. We also have this ascending wedge coming through, and a lot of traders like to wait for the ascending wedge to break out, pull back, and then get in right here. That's completely fine if you're a more conservative trader. In situations like this, I like to be more aggressive, which is why you saw me buy earlier. So now let's break down the way I trade these patterns, because again, I'm not just placing a trade, going 1-to-1 reward to risk ratio and hoping that ascending wedges work out. The formula for success in any trading strategy is that you either have a higher than 1-to-1 reward to risk ratio with a higher than, let's say, 40% chance to win, and that's just a generalization, or you have above a 50-50 chance to win and a 1-to-1 or higher in terms of reward to risk ratio. So in this case, the average trade that I take based on these exact rules that you just learned ends up being about a 2.5-to-1 reward to risk ratio. I have no idea what this trade will do. This is something really important for you to understand, especially if you're a beginner or someone that's been struggling for a while in trading. I have no clue what this is going to do. Could Bitcoin drop right now and stop me out? Absolutely. Could Bitcoin go to 10K right now? For sure. I have no idea. Could Bitcoin reverse and head higher? Yes. So the faster you get out of the mindset of I know what cryptocurrency or stocks or Forex is going to do, and the faster you understand that you're trading based on a statistic advantage, the better off you'll be. Let me explain what I mean by statistic advantage. Here on this specific trade, I know throughout my testing and experience that I probably have somewhere around a 40% chance to win this trade. You may be asking, Stephen, if you only have a 40% chance of price heading higher based on the rules of this strategy, then why are you trading it? Well, at a 40% chance to win, combined with my 2.5-to-1 reward to risk ratio, over a long span of time, I'm going to make money. Let me use a calculator to explain that better. So throughout the next year or two, I will have 100 trades like this, and I will take every one of them that I have the opportunity to. Whenever I see the price of a crypto or stock or Forex get to a major level of structure, put in an ascending wedge, I will buy off of the bottom of the wedge on the third test. 1, I'll call the first test the low, then 2, 3. I'll buy off of that every time for the next 100 times I see this, right? So if I do that throughout all markets and it stays at about a 40% win rate, if I win 40 trades times my 2.5 reward to risk ratio on average, and then I lose 60 trades with my 1, right? Because I'm using a 2.5 to 1 reward to risk. So my risk is 1. So that means all 60 of those trades, I lost 1. That leaves me with what's called 40R, which is 40 times my risk. Normally, I risk about 2% of my total account value per trade. That means that doing this 100 times over the next year or two, depending on how many times it happens, is going to make me, that's a weird 8, jeez, is going to, Jesus, my dyslexia is kicking in. How do I draw an 8? That's an S. 8D%. I know what you're thinking. Yo, I'm learning how to trade from a guy that can't draw an 8. Look, I've had dyslexia my whole life. It's weird, but it happens. So I'm going to make 80% back on track. I got a little bit of ADD too. So trading this over the next year or two, trading it 100 times, will make me roughly 80% ROI. This is the reason we look for rules-based strategies that give us an edge. And this is the reason how you trade this specific pattern really, really matters. So if I traded it with a 1-to-1 reward to risk ratio and got 50% of the time I won, like it wouldn't be profitable, right? But since I set myself up every time with a favorable reward to risk ratio, since I wait for the price of an asset to get to a major level of structure, then wait on this pattern to occur, then I have rules for entering after the third test of the trend line of the ascending wedge, all these things come together to give me an advantage over a long period of time, which is what we look for as traders. That goes back to the point I was making earlier. I'm not thinking this is the bottom of Bitcoin. I honestly believe it's going to go lower eventually. But considering the fact that we had a big news event that took away some fear. Look, everyone's fearful because obviously a 9% inflation is terrible. But that fear is less than the fear of uncertainty, which was there before the news event came out. And that release of some fear can often cause retracements in financial markets. You combine that with all of my technical factors here, and you have what I consider to be a winning proposition to place a trade. And again, a trade I'll make for the next 100 times it happens on all financial markets. Another thing I will say about this strategy is I want to make sure my 2.5 reward to risk ratio comes in before my next major level of structure, which in this case, it does very easily. And what I will do actually for this specific example is I'm going to get below 25,000 with my target. So let's go below 25K with my target. And now I want to explain why I put 10,000 in, okay? On this specific trade, this is another part of swing trading, especially in crypto with how volatile it is and how unknown it is. First, let me do this. First off, we can get lucky too. So what I mean by that is not only are we putting ourselves in a position, am I putting myself in a position to get this overall expected outcome positive? I know that sentence was backwards. This overall positive expectancy over a long period of time, over 100 trades, 80% ROI, if it continues to perform at a 40% win rate with a 2.5 to 1 reward to risk ratio. But also there's an opportunity here that we're not thinking about. What if this happens? I don't take targets off here, but instead move my stop to break even. And then we get this volatile reversal that we see in financial markets, especially crypto sometimes, and I stay in the trade. So you're putting yourself, I'm putting myself in a very good position by doing this, even though there's a possibility I get stopped out. I'm willing to take that risk. So now let's talk about risk. One of the major things you need to realize whenever trying this in the crypto market especially is a stop loss is more than necessary. It is imperative. You must use a stop loss to ensure that price doesn't go crazy volatile to the downside and completely crash and you lose your entire account. So the reason I placed this trade with $10,000 is because this is a risky trade. $10,000 is not what I stand to lose on this trade. I will have a stop loss set that will only lose $1,000. So $1,000 is all my risk is considering my stop loss. And outside of some unknown crazy event where my stop loss doesn't get hit, that's all I'll lose on this trade. And that $1,000 risk is completely acceptable for me considering how risky this specific trade is and the size of my account. You'll have to determine that number for yourself. Hey guys, I just wanted to jump in here real quick because I realized that I did not give you the equation to calculate this stop loss. I just told you I had a 10K position size and I was risking 1K. That's not very helpful. So let me give you the equation to calculate stop losses. That way you can do it in your own trading. Essentially, what you want to do is take the amount you want to risk and divide that by your stop loss, which we're going to say is just an even 2K for simple math. And that's going to give you the amount of the asset. Like this is going to give me the amount of Bitcoins I need to buy. This is 0.5. I'll do this on a calculator to make it easier. So let's bring up a calculator. We have our $1,000 risk. We divide that by our stop loss, which is $2,000 roughly. Again, simple math. And we get 0.5. So this is the amount of this asset I need to purchase. At this point, in order to get the dollar amount that you need to purchase in order to risk $1,000, as in your actual position size, you have to multiply this by the price of the asset. So at the time we purchased, it was about $20,000. Again, easy math, which gave me a $10,000 position size. I did that really fast. Feel free to rewind and rewatch that. It's a pretty simple process once you go over it a couple of times, but let's continue the video. When you get into trades like this that aren't super high probability, like I said, about a 40% chance to win, you may want to look at reducing your risk on that trade. You don't have to risk your entire account balance. Remember, when we're trading, it's based on statistic advantages. No one knows exactly where price is going to go. If you have a 40% chance to win, what does that mean? That means you have a 60% chance to lose. You don't want to bet your entire account value and then lose it all because of this 60% chance. The point of trading is to minimize your losses and risk a small enough amount where you can have a 40% win rate and still come out profitable because you have a small enough risk to protect your account during times when this 60% losses are happening, right? You want to protect your account during those times. So risking a very small portion of your overall account value is how we do that. Like me, I'm only risking $1,000 on over $120,000 account. This is less than 1% risk of my total account value, which is completely fine for me for a trade like this with a lower probability of winning. So that is something else you must keep in mind when swing trading in the crypto market, is ensure that you have a very small risk in comparison to your overall account value, and always use a stop loss because this market is insane. It is so volatile and it can go against you very fast. So it's incredibly important for you to use a stop loss and make sure that stop loss is a small amount of your total account value. Now, just to put a bow on this video to wrap it up, let me show you something I call the triangle of trading success so that you can understand the steps you need to take in order to become a profitable trader. It's not all about the strategy you use. A lot of it has to do with risk management, which is what we just talked about, along with trading psychology. And I'm going to try to explain that with the triangle of trading success here. In the middle of this triangle is all the traders that are actually making money. What do they have? They have a strategy that makes money over time, kind of like the one we just talked about. Not a strategy that tells them exactly what the market's going to do every single time, but a strategy that makes money over the long run. They also have a risk management plan that keeps them safe during drawdowns. Remember, if you have a 60% chance to lose, chances are you're going to lose more than you win. You want to stay protected during those losses, and the way you do that is by having a risk management plan that keeps you risking a very small portion of your overall account value on every trade you take. And just because you have a 40% win rate doesn't mean you're going to lose money over time. Remember, 40% win rate with a 2.5 to 1 reward to risk ratio, that equals profits, okay? That equals profits over a long period of time. But you must have a risk management plan that keeps you in the game long enough to let that statistic advantage play out over 100 trades. The third thing we haven't talked about much in this video is trading psychology. So trading psychology is your ability to kind of stay disciplined throughout a losing streak. Your ability to stay disciplined to your risk management plan, even if you've lost a few trades in a row and you feel like revenge trading, or if you like need money that day for some reason, you're like, oh, I'm going to risk a lot more because I just need money for rent. That's bad trading psychology, and that's not what you want to do. If you're switching strategies constantly, bad trading psychology. So these are the three things that you must master in order to become a profitable trader as a career. You can get lucky every now and then, place trades, and sure, the market goes your direction. But if you want a career as a trader and you want to be profitable over a long, long period of time, these three things must be mastered. So if you haven't mastered them, just look them up. We have videos on all three of these topics throughout our YouTube channel. Feel free to check them out. You can literally type in strategy, the trading channel. You'll see a ton of our strategies. You can type in risk management, the trading channel. We have videos on that. You can type in trading psychology, the trading channel. You'll find videos on that. All of that you can type into the search bar on the top of YouTube. With that said, if you enjoyed crypto content today, then go ahead and comment below and let me know, and I'll make more crypto content in the future. If you did enjoy this video, please go ahead and subscribe if you are new. If you'd like some more advanced education on crypto, let me know that in the comment section below as well. We don't have a crypto specific course right now. We do have the TTC FX University, which is similar concepts to what I use in crypto. It's just based around the Forex market. But if you want to check that out, it is the top link in the description, or you can go to www.ttcfxuniversity.com. If not, totally fine too. Still wish you the best of luck in your future trades, and I'll talk to you in the next video. See you soon.